Okay. So chapter 22 is all about standard costs, and then we're going to take what we call standard costs, like what, basically if you kind of did the little, I think most of you did the chapter 22 adaptive learning plan, you know, it talked about basically standard costs are the costs that it should cost, right? You know, it's in theory. So, you know, we calculate standard costs based on, you know, normal costs that we think will happen under normal operating conditions. So obviously they're not exact costs, it's what they would be under favorable conditions. But we're going to use those standard costs to try to, you know, predict and then kind of set like our budget. So standard costing is used when we set our budget. So we go off of what the cost should be, but we know in reality that those costs can change, right? Because what if we're more wasteful than usual on materials, so it takes more materials, or prices go up on materials, or we have unskilled laborers that cause us to use more labor hours, or we have highly skilled laborers that earn more than what we budgeted for. So there's lots of reasons that costs can vary in our actual production versus what our standard costs set are. So it's important to come up with standard costs so then we can set our budget, right? So we know what to budget for. And then this chapter is really all about comparing like our budgeted or standard costs versus our actual costs, okay? So we're still using a lot of the same theories we talked about in chapter 21, like the budgeting and the flex budget especially, because sometimes our standard costs are set at a standard level of production and we need to flex them to our actual level of production to compare them. So chapter 21 and 22 really do work in tandem, but I think they're a little bit easier chapters too, though, so that kind of helps. So again, you know, like your notes say, standard cost is just how much a product should cost. So again, that's found by, we're not taking like ideal costs here. We're not looking at, you know, best case scenario or worst case scenario. We're really trying to find a pretty good cost for our product. You know, taking into, when we set that standard cost, we're taking into account, you know, current supply and demand, you know, if there's any problems with finding materials or labor or anything like that. Okay, so we're not going to have to set the standard cost. Standard cost will be given to us, and then basically we're going to compare it to the actual cost to figure out what our cost variances are. And of course, a variance is just a difference in a cost. From a managerial standpoint, it's really important to find out why our costs are higher or even lower so we can plan and we can, you know, adjust. So every time we have a different like cost variance, we're going to look at, well, the underlying why. Of course, in this class, we're going to calculate it and talk about it. Obviously, we can't go ask the people why, but in a real scenario, the accountant would be responsible for reporting all this data, and then that data would go to like production, and production department would be like, okay, well, why did we use more materials than the standard amount? And then it might go to purchasing. Well, why did we spend more? Why was the labor cost, or not labor, but materials cost higher than what the standard was? So there's different departments that are affecting this, right? So the accountant will look at the overall variances, and then it'll go to like human resources over labor or production or purchasing, the divisions that actually have the say on how materials are purchased or what price we purchase them at, or labor. So we're going to look at all of our manufacturing costs. So we're just looking at price variances right now for manufacturing, so materials, labor, and overhead. As far as variances go, we're not going to delve really deeply into the factory overhead variances because those get really tricky, but we are going to do specific materials and labor variances. We're still going to look at overall factory overhead variances, you know, where we over or under, but those, when we get into the specific, like the overhead control cost centers and all that, it gets tricky. So the only kind of tricky thing, of course, is like we put in a favorable variance as a negative in this chapter, which sounds weird. But I have that on your notes as to why. So obviously a favorable variance is when our actual cost is less than the standard cost. So when it costs us less than the standard, it's favorable. Unfavorable would be when actual is greater than standard. So basically what happens is favorable variances get credited to the appropriate account, like materials. Well, materials is an asset, right? When we're increasing an asset, we're debiting it. So that's why, since we're a very favorable variance gets credited, it's going to be shown as a negative. Okay, it just sounds weird, but it's due to debit and credit. Okay, so I put that on your notes. That's why favorable variances are, I think I put it wrong though, didn't I? Oh my goodness, I'm so sorry, I typed that up wrong. Oh, good times. It should be favorable variances are negative as a credit. I will change those and reprint those for you for next week. I apologize for that. It was right in my mind, but I typed it out wrong, so that's actually backwards. A favorable variance will actually be a credit. So the wording is correct, the first sentence, but the second sentence should be favorable variances are negative or credit. Okay, I apologize for that one. Okay, so the first one, we're going to calculate standard cost for an item. So this one's pretty simple. It says Roanoke Company produces chocolate bars. The primary materials are cocoa, sugar, and milk. And it says the standard costs for a batch, which is 5,200 bars, are as follows. And they just want us to calculate the standard direct materials cost per bar. So they give us the cost for a batch of 5,200. So basically all we have to do is calculate total costs and then divide by 5,200 to get a cost per bar. Pretty simple, right? Probably didn't even need to do that one together, but you know, just talking about standard costs. So cocoa, of course, we would take 400 times $1.25. So it should be what, 500? Sugar is 80 pounds times 40 cents per pound, which is $32. And milk is 120 gallons times $2.50 a gallon, or $300. So our total cost should be, all of those added up, is $832. So we just multiplied, added up, $832 divided by the 5,200 bars. Okay, so should get what, 16 cents per bar. Okay, so that one's pretty easy. So again, that's just calculating the standard direct materials per unit. Okay. And that, of course, will be important when we compare actual, because then we can use that per unit cost to figure out what actual should be at any level of production, okay, using that flex budget process. Okay, so that's kind of really a review even. Same with the second one. The second one is kind of still dealing with standard product cost. So this one's dealing with a furniture company, and it uses a standard cost system. So they're showing us, you know, our labor, materials, and then both variable and fixed factory overhead, and they give the rates. And this one is for one unfinished dining room table. So in this one, we're only calculating one. So for labor, all we need to do, you know, we're just calculating how much it takes total for each one. So it's kind of going back to the budgeting, right? For labor, it would be 3.5 hours times $18 per hour. So our total labor would be what, $63. Materials, which is the oak, is $15 per foot, and standard quantity is 26 feet. So $15 times 26 feet. Materials cost $390. Variable overhead is $420 per direct labor hour. Well, we have 3.5 labor hours, right, per item, so 420 times 3.5 hours. Variable factory overhead is $14.70. And then our fixed factory overhead is $1.80 per direct labor hour, so $1.80 times 3.5 hours, or $6.30. So once we have all of our manufacturing costs, labor, materials, and both variable and fixed overhead, since they've broken them out per hour, we can just add them all up. And each table, the standard cost is what, $474? $474. Okay. So again, this is based on, standards, how long it normally takes, how many materials it normally takes, all of that. So that's what we're going to budget off of. And this goes back kind of to our budgets anyway, right, on how you calculate labor costs and all of that. And then Part B just says, a standard cost system provides Santa Rosa Furniture Management a cost control tool using the principle of, well, it's called management by exception. Management by exception. Using this principle, we're looking for major cost deviations. So major cost deviations from standards can be investigated and corrected. Okay, so that's our goal here when we set standard costs. That's what the cost should be. And then once we have our actual costs, we're going to compare those two and look for variances. Once we find variances, we determine if they're favorable or unfavorable. And from there, we determine, who that information goes to and what changes need to be made. Okay. So again, this is like a monthly process, right? Because costs can vary month to month. So this next one, we are given costs for labor, materials, and overhead. So we're making 2-liter bottles, and it gives us a standard cost to make 100 2-liter bottles. So obviously it's very cheap. They charge us a lot for those 2 liters, don't they? When it costs $11.65 to make 100 2-liter bottles. Of course, that's not the soda in it too, but still. Just shows you, right, how much they charge us for things. So that's the standard cost for that. And then the next part tells us at the beginning of July, GBC management planned to produce 400,000 bottles. And the actual number of bottles produced for July was 406,000. Okay, so that's our actual. And then they give us our actual cost for July. Okay. Well, we have our standard costs and we have our actual costs. So this is kind of when we use our flexible budget information. We need to take our standard costs and flex them to our actual production, right? So we can compare it. Because we have our costs up here. The standard cost per 100 2-liter bottles. Well, we don't want it per 100. We want it per, we want a total of, well, they want the standard cost at 400,000 actually, so we can compare it. We're not even going to compare it. I'm getting ahead of myself. I'm trying to do more than what they want. They just want us to prepare the July manufacturing standard cost budget. So assuming 400,000, okay? From there, we could then flex it to 406 to compare actual. But they just want it to 400,000. So obviously, they gave us per 100. So instead of dividing or multiplying by 400,000, multiply by, 4,000. Does that make sense? So these are the standard costs per 100. We basically have 4,100 2-liter bottles. Okay, because this is by per 100. So they're basically, you want to take 400,000 divided by 100. So we're really wanting to multiply all these numbers by 4,000 to flex it to the 400,000 level. So what would my direct labor be at 400,000? $8,000, good. So 2,000 times 4,000, basically. 8,000. How about materials? Very good. 36,400. So the $9.10 times 4,000. And then factory overhead is what? 55 cents times 4,000. So factory overhead would be 2,200. 2,200. So all total, our standard cost at 400,000 bottles would be 46,600. 46,600. Okay. Now we're going to take that standard cost information and we're going to prepare a budget performance report showing cost variances. Okay. Well, we have to flex that standard. We have the standard cost at the planned volume. Those are the standard costs. In order to compare to the actual, we need to flex this to the 406,000 level. I was getting ahead of myself a minute ago. So we're going to take this information, or even just the standard cost per 100 liters above. We want to calculate what the standard cost would be at 406,000 so we can compare them to the actual cost. So in the first column here, for actual costs, those are just given, right? We have those up here in this table. They told us what our actual costs were at 406,000. I'm just going to carry those down. So actual direct labor, page here. Actual direct labor was 7,540. 7,540. Direct materials was 35,750. 35,750. And overhead was 2,680. 2,680. So our total manufacturing cost should be 45,970, which they gave us. 45,970. And then again, we just want to flex that, the standard cost, to the actual volume of 406,000. So in other words, we could take $2 times 4,060 is probably the easiest way of doing that. So I took my direct labor cost of $2 times 4,060. And you should get 8,120. 8,120. And when I look at that, now that I've flexed it for the labor, you know, before when I just compared the standard cost to the actual cost, it looked like standard costs were higher, right? Or lower, actually. Sorry. No, they were higher. They were a little higher. But my standard labor cost, or standard, direct labor cost was 8,000. So now that's increased, of course, because we're considering the actual volume of 406. So the actual costs are less than the standard costs. Okay. Hey, I'm glad you came. Thank you so much. You found it. So material or labor, sorry, we're on labor. Labor actual costs are less than the standard. So is that a favorable or unfavorable variance? If our actual costs were less than the standard, do you think that's a favorable or unfavorable? It's favorable, right? Since our actual costs were less than the standard, then we actually have a favorable direct labor variance. So I'm just going to take my actual minus my standard. And again, we're going to put the favorable in as a minus or a negative. So minus 580. Okay. So our direct labor variance was favorable since the actual was less than the standard. And for direct materials, I'd want to do the flexible budget for it. So I would take my $9.10 times 4,060. And my materials standard cost at actual volume would be 36,946. 36,946. So is that favorable or unfavorable? It's also favorable, right? Because our actual is less than our standard. So again, I would subtract, take my actual minus my standard. I get minus 1,196. 1,196. And then last but not least, I would calculate my factory overhead. So factory overhead is 55 cents times 4,060. 2,233. 2,233. So is that favorable or unfavorable? It's unfavorable because our standard is higher, lower than our actual. So our actual cost is higher than our standard cost. So we came in above the standard cost by 447. So we have an unfavorable factory overhead variance at 447. So to figure out my total variance, of course, I could just add up my total standard cost of the actual production, which is 47,299. 47,299. And then you can calculate your total variance by either, adding up your negatives and adding in that 447, or just calculating the difference between the two totals. Okay. So I could just take my actual minus my standard. Probably the easiest anyway. And you should get a favorable minus 1,329. So that favorable variance of 1,329. And again, favorable variances are going to show us a negative because they're being credited when we actually journalize them. So that's why it's important. That's why we learned how to do the flexible budget in chapter 21. Because if we compared to just the standard budget of 400,000, it wouldn't be accurate. So we flexed the standard to the 406 actual level. That way we can compare the actual cost to the standard cost. And then overall, we had positive or favorable material and labors. We came in under cost in labor and materials, but we were a little over in factory overhead. But all total, we had a favorable variance. So we're pretty happy. So the company's actual costs were 1,329 less than budgeted. And then again, we had favorable direct labor and direct material, and those more than offsetted the unfavorable factory overhead cost variance. So again, these reports that the accountants would run would then go to the various departments like production and all of that to find out if they could find a reason why factory overhead was higher. Were utility costs just higher this month due to some reason, or they would look into that. It's not a huge variance, and obviously our total costs are down, so we'd be pretty happy with that result. But we might need to budget differently for next month based on these figures, and we may even need to readjust our standard cost budgeting forward, because obviously materials were a decent amount lower, so maybe materials pricing has dropped. Okay, so it's just important to determine those, and that way we can make decisions for future budgeting, and also trying to get anything under control, right? If we had a huge variance, we would want to know why, and so that's why we do this. It's kind of the same. It's the same as like doing your own. If you ever do your own budget for your household, and then compare the actual, and then you cry a little bit, right? I talked about that before. So it's like, yeah, I don't know. But you can see where you need to cut costs, right? Like ours is usually in food, unfortunately. So, maybe clothing and or eating out. Usually it's food. So it's usually fast food or something. And then you can identify an area that you might need to control or look at. It's the same from a corporation standpoint, only obviously it won't be fast food. But it could just be labor. Like, why is our labor cost so high? Well, we might want to look at that. Are we paying people higher wages, or are they unproductive? What's really going on there? So that's the whole reason that we calculate and try to find out our variances, our cost variances, so we can get them under control. Like this month we're ahead, but next month it could be a different picture. Okay. And sometimes it's out of our control. If it were like, maybe we used more materials because there was a problem, with the equipment and it malfunctioned and it ate up some extra materials. But we're going to know that, right? We're going to go talk to the factory supervisor, and he's going to be like, oh yeah, we had a lot of waste, and so we're going to be able to account for that. And it would be an abnormal variance versus one that maybe our workers are just, doing something incorrectly, but we can identify that and fix it and change our situation. Okay. Let's see, this next one is dealing just with direct materials variances. So like on your notes, you can see kind of towards the bottom, the total materials variance is like what we just calculated. We just took our total direct materials cost, the actual, and compared it to standard. But we can also look for price variances and quantity variances. And the reason we want to break it down separately is, again, it helps us identify which area the problem exists in. If we have a price variance, then we're going to go to like the purchasing department and be like, why were materials higher than what we planned, right? Versus if it's a quantity issue, that's going to go to the factory supervisor or production department and be like, why are you using more materials than the standard? So that's why we kind of break it out to do quantity and price. So really, these are pretty simple. It's just using the formulas, okay? So for example, they give us our actual. It actually took us 145,000 pounds at $2.80 per pound to make 10,000 tires. But the standard is 150,000 pounds at $2.75 per pound. So we can already, when you just eyeball it, right, you can easily see that it took less quantity, but more, we paid more, our rate was higher. So, I mean, obviously you can tell, but we want to calculate the actual variance. So how we do that, direct materials price variance. Well, again, you have your formula on your notes there. So for the direct materials price variance, we always take the actual price, which is $2.80, minus the standard price, $2.75. So actual minus standard. And then we multiply it by our actual quantity. And our actual quantity was 145,000 pounds. Okay. So actual price minus standard price times the actual quantity. And you should get 7,250. Okay. 7,250. And that is unfavorable. And the way I know that is it returned a positive number. It's wrong on the notes, by the way. I'll correct it for you before we leave. If it's positive, then it's unfavorable. Okay? So we have an unfavorable materials price variance. So our direct materials price variance, 7,250, and it is unfavorable. Okay? Unfavorable. Next, we'll do the quantity variance. That's price. So the quantity formula, and you have that in your notes too, of course, is your actual quantity, the 145,000, minus your standard quantity, 150. So actual quantity minus standard quantity, so 145 minus 150, times your standard price of $2.75. Okay. The actual quantity minus standard quantity times the standard price. What is my quantity variance? Negative 13,700. Very good. A negative 13,750. So since we got a negative number, that's actually a positive variance. Contrary to your notes. So that one is a negative 13,750, and it is favorable. Okay. Well, to get our total direct materials cost variance, we can just add those two together. okay? You could calculate it too by, you know, it would be the same as taking the actual. You would take 145,000 times 2.8, you know, minus the standard of 145 at 275. You can do it that way too, but it's quicker to just add those two together. So what is my total direct materials cost variance?
Negative 6,500.
Very good, a negative 6,500. And that makes it a favorable variance, okay? So again, we can obviously see just by looking at it that we had a favorable quantity variance. But as far as putting a dollar amount on it, if we do that formula, we can see it actually cost us $13,750 less, you know, just for quantity. But our price was a little higher, right? It was 5 cents more per pound, okay? But all total, we were still 6,500 favorable variance. So our actual costs were less than our standard costs. So the whole purpose of this, again, is to identify problem areas and report that to the proper people. So on B, it says the direct materials price variance. The price variance needs to be reported to purchasing, okay? Again, you know, purchasing might have a reason. Maybe they purchased higher quality materials, or maybe, you know, the supply is down, so the demand is up and cost goes up. We don't get into economics, don't worry. But you know, there's a lot of driving forces there. But we want them to know that we have this price difference. If lower amounts of direct materials had been used because of production efficiencies, the variance would be reported to the production supervisor. Okay. Well, we did use less quantity, right? We used less direct materials. So maybe we were just really efficient that month. Maybe we have really skilled workers who actually did a really good job. And so the quantity variance is going to be reported to the production supervisor. Okay, and that's a good thing, of course. And then the last one, it says, if the favorable use of raw materials had been caused by the purchase of higher quality raw materials, that would go to the purchasing department. Okay. So we're not 100% sure, you know, so it's going to go to both departments and find out, well, did we buy higher quality materials, which yes, caused a slightly higher price variance, but that was really offset by the quantity we used. So it was a good idea, wasn't it? Ultimately, if that were the case, spending a little bit more on materials paid off because we still came in under cost, okay? So again, that's all the decision making that goes into this. You know, we're running the reports and then we forward this on to the proper department. Any questions on that one? Okay. So the next one, as you can probably imagine, deals with labor. Okay. So we're going to look at direct labor variances. Kind of the same idea in that we're going to have, you know, the hours that we used, and then we're going to have the rate that we pay employees. So with labor, we have a rate variance. Are we paying our laborers more than what we planned? And a time variance. Are we using more hours than what we planned? And again, we can see we actually used more hours, but we paid our workers a little bit less. So it may have taken more hours because we have some workers that aren't as skilled as we thought we would. So we're going to calculate the actual variances. Okay, so the first one we're going to do is the rate variance. The rate variance. So for this one, we're going to take our actual pay rate, so the $22.50, minus the standard rate of pay of $23. So actual rate minus the standard rate. And then we're going to multiply that by the actual hours, 8,450. Okay. So actual rate minus the standard rate times the actual hours of 8,450. What is our rate variance?
Negative 4,225.
Perfect. Negative 4,225.
Favorable.
Favorable. Yay. Always makes us happy, right? Just throws us off that it says negative. And then for time, we are going to take our actual hours of 8,450. 8,450 minus our standard of 8,400. So actual hours minus standard hours times our standard rate per hour of $23. So actual hours minus standard hours times standard rate of 23. And what is our time variance?
1150.
1150.
Favorable.
1,150. And you're right, that is unfavorable. Unfavorable. So we've already calculated these. So our rate variance was a minus 4,225. Favorable. And time was 1150. Unfavorable. So what is our total labor variance?
Negative 3,075.
Very good, negative 3,075. Just added those two together, and it's still favorable. So yeah, it took us some extra hours because we weren't paying our employees as much, but they still did a pretty good job apparently because we came in under cost. Okay. So basically, the employees may have been less experienced or poorly trained, one or the other, no big deal. Therefore, resulting in a lower labor rate than planned. Okay. So again, we would probably go to production department to determine, do they need more training or are they just, newer employees? The lower level of experience or training may have resulted in less efficient performance. So therefore, the actual time was more than the standard. But again, looking at it overall, it was okay in this situation because we still had a favorable direct labor cost variance. Just took them a little more time. Any questions on that one? Honestly, those are pretty easy, right? As long as you just follow the formulas and just remember favorable is a negative. All right, last one. Let's see. This one we're doing flexible overhead budget. So again, we're not going to do any variances on our factory overheads because they are kind of difficult, except for like total cost variances. But we can look and compare at different levels of production what our overhead costs would be, okay? So this one's just telling us Lino Manufacturing prepared the following factory overhead cost budget for October of the current year, and it is expected to require 20,000 hours of productive capacity in the department. So they give us, our variable costs and our fixed costs. And they said, assume that the estimated costs for November are the same as for October. We just want to take this information and do a flexible budget, okay? So we want to do what our overhead would be if we used 18,000 hours of production versus 20 and 22. Well, the great thing is they gave us the 20. So we can just fill that in, right? I like it when they do that. So I'm going to do the middle one first, just because it's easiest. So 20,000 indirect factory labor was 180,000. 180,000. Power and light was 12,000. 12,000 for power and light. Indirect materials was 64,000. 64,000. So total variable is 256,000. 256,000. And then our fixed Honestly, well, we know fixed is the same under any level, right? So I can fill in the whole fixed, which makes life even better. So we really don't have a lot we have to calculate. Supervisor salaries are 80,000. So it doesn't matter what level of production. Supervisors are 80,000. Depreciation is 50,000 across the board. Depreciation 50,000 across the board. Insurance is 32,000 all the way across. 32,000. Okay. And our total fixed is 162,000 at any level. 162,000. Okay. So the only thing that we need to calculate is our variable cost. Okay. Well, it's best to calculate unit costs, right? Then we can flex it in any level. So when you're doing a flex budget, it really is the easiest thing to do is just calculate the unit cost first, and then you can use that unit cost to find the cost at any level of production. Okay, so I'll write them out. I know it's easy, but just so we have them, it's easier. So we have indirect labor, IL for indirect labor. At 20,000, it's 180,000. So 180,000 divided by 20,000. 9 per unit. $9 per unit. I like it when I can do it in my head, right? It's so much easier. Power and light. Power and light is 12,000 divided by 20,000. And that would be, what, 60 cents per hour? Per hour. So power and light is 60 cents per hour. And then our last variable is indirect materials. And it is what, 64,000 divided by 20,000, or $3.20 per hour. Okay. So when you do a flexible budget, calculate your unit cost first, and then you can use that unit cost and figure out your cost at any level of production. So at 18,000, what would be my indirect factory labor? Be what, $9 times 18,000 hours. Bless you. Did you guys get 162,000?
Yes, ma'am.
Okay. So 162,000 for factory labor. Power and light is 60 cents times 1,800 hours, or 10,800. 10,800. Materials are $3.20 times the 18,000. So 57,600. 57,600. So at 18,000, our total variable overhead would be what, 230,400. 230,400. And then so to get our total factory overhead, variable plus fixed, so 392,400. 392,400. Now I never put in my total factory overhead under 20,000. Was 418,000. 418,000. Missed that one. And then of course I can calculate at 22,000. So it's $9 per hour at 22 hours, or 22,000 hours, sorry. So 198,000. $198,000 for indirect labor. Power and light is 60 cents per hour. So 60 cents times 22,000. 13,200. 13,200. And then indirect materials are $3.20 times 22,000. 70,400. 70,400. So total variable overhead is 281,600. 281,600. And then variable plus fixed. Our total overhead should be 443,600. 443,600. Excuse me. So again, if we wanted to calculate our variances just for total overhead, we now have total factory overhead at 3 different production levels. So if our actual was 22,000, we could compare it to this and see what our variance was. Okay. But again, we won't do any variances in overhead except for total overhead, because those they get really tricky. So I'm done pretty early there, aren't I? Any questions on chapter 22 or 21, since we're on both chapters? It's really not too bad, is it? Yeah, it's kind of a nice break from some of the harder stuff. So as far as schedule goes, next week we will review. So be working on 21 and 22 homework. And so if you have any questions, we can do like a homework problem together or anything next Wednesday, and we'll review. And then we'll talk about the data analytics project too. I think we'll have time to do that. And yeah. And we just have 2 chapters left after that. What? So saying to my other class, it's like this time of year,